The following is a production of Professor Robert Barnwell. Each episode includes insights provided by the chairman, CEOs, and CFOs of the world's most successful corporations, as well as thought leaders from premier business schools and international consultancies. If you and your team would like more information on corporate leadership and strategic management, or would like to learn more about Professor Barnwell, his research, and how he may be able to assist your company, please visit Professor Barnwell's website at robertgbarnwell.com.
Hello and welcome to CFO Talk Radio. I'm your host, Robert Barnwell. During the last episode, we spoke with Don Malyard, a partner with KPMG and the U.S. leader of KPMG's Financial Management Advisory Group, about corporate cost-cutting strategies. This marked the third episode in a special four-part series featuring several senior professionals from KPMG. This is episode 15, and during this fourth and final installment of this special four-part series, we'll be speaking with two KPMG professionals in a unique roundtable discussion. The discussion features previous guest, Steve Miller, the national leader of KPMG's Integration and Separation Services practice, and John McPhee, a partner in KPMG's Advisory Transaction Services practice and the leader of KPMG's Sell-Side Services. Steve and John join us to discuss a particularly important and potentially powerful topic, divestitures. John, Steve, welcome to CFO Talk Radio.
Thank you, Robert.
Same here. Thanks, Robert. Pleasure to be back.
You know, John, as we've mentioned before, the subject of mergers and acquisition gets a lot of attention. In fact, even here on CFO Talk Radio, we've dedicated a significant percentage of our episodes to M&A transactions, including one with Steve, actually, focused on merger integration. Yet study after study suggests that the impact of thoughtful divestitures well exceeds the value of mergers and acquisition transactions. And I'd like to know that, in your opinion, why is it that so few companies and senior management teams seem to embrace or even consider divestitures as an attractive option?
That's a good question, Robert. Inherently, divestitures are much more complex than acquisitions. There are tremendous psychological differences between the two. An acquisition is really a positive event. It's like a marriage. Senior management will be actively involved because everyone loves a good wedding. Depending on your perspective, a divestment generally is viewed as a negative event. It can imply that you failed in operating the business. In many cases, it's like a divorce. There's angst and there's hard feelings. Even though there's tremendous value at stake in typical organizations, senior management makes the decision to divest and generally delegates the responsibility to execute it to those with less experience. If you do not proactively manage the divestment process, value erosion begins and can derail the process. You know, as an analogy, think of an acquisition like ordering a meal in a restaurant. You know, all you have to do is place your order and then eat it. With a divestiture, you're selling something and need to prepare the meal. And if you just think of all the preparation that goes into a successful holiday meal, it takes a lot of planning and then focus on execution to make a divestment successful.
That's a very interesting analogy. Now, John, as the senior executive teams that you support, look over their portfolio of businesses, what criteria do you think that they should be considering in trying to determine whether or not, a particular business, or product line should remain within the company's current portfolio or it should be divested?
Well-run organizations have a strategy for each business and or product line and a metric that they view as successful return on their investment. Typical metrics are things like gross margins or brand contribution on particular products, business unit operating profit, EBITDA, cash flow, etc. Many product lines have initial high margins, but then the margins erode over time. Management is typically trying to balance the performance of a portfolio of products or business units to earnings targets. If those product lines or business units begin to dilute margins and or earnings targets, then they're typically considered for divestment.
Now, Steve, as the same executive team works through these more strategic points around whether a business should be divested, what issues should they, also consider to assess the risk and maybe overall complexity of operationally executing the separation?
Sure. I mean, Robert, there's obviously a broad range of things, we want to look at, but one of the more obvious considerations is really the degree to which the business being divested is integrated with the parent. And we see a pretty broad range of divestiture types, from divisions which are already pretty standalone that just kind of report their numbers up for consolidation, all the way to the other end where we see brands that are so embedded in the operational sort of infrastructure of the parent, it's really almost impossible to tell where one begins and the other ends, and you've got, pretty major surgery needed to separate them. So the time and expense that a seller ought to budget to operationally prep a business for sale prior to close and then execute that transition varies a tremendous amount between those two ends of the continuum. The challenge, however, is that a lot of sellers can be surprised to discover a division they thought was on that more standalone end actually has just a lot broader range of entanglements with the mothership than they thought. They're just not very visible after being a part of the whole for so many years. So incorporating an upfront, operationally deep assessment of that level of current integration in the early deal phases is really important. It helps you kind of get in front of a range of issues that should be baked into the deal timelines, like valuation models, and then the purchase and sale agreement itself. Another area we should mention just real quickly is getting a preliminary understanding of stranded cost. And what we mean by this are costs that are associated with the business being sold but aren't going to go with the sale itself. These can be difficult to wind down, take longer to eliminate than anticipated. And another item is stranded cost. These are diseconomies to consider, such as bulk pricing benefits that'll be lost when volumes you formerly procured together with the divested business can no longer be aggregated with the overall corporate volumes. So the dollars associated with just these two examples can be really meaningful and should be worked into the valuation model. But the kicker here, to state the obvious, is you can only work them in the model if you include this analysis early on in the deal when you still have time to do so.
Interesting. I think these are things that would probably escape us, at the initial consideration, the impact of these stranded costs. Now, assuming that the company has identified a business that it feels is no longer core to its ongoing operations, what are some of the next steps and considerations that the executive team really needs to address? John, perhaps maybe you could step us through the initial tasks to position the asset for sale and structure the transaction itself, and then we'll ask Steve maybe if he could outline the initial operational preparations.
Sure. Well, one of the most common issues we see when looking at divested businesses on the buy side is that the perimeter of the transaction has not been properly defined. You must start by defining what exactly you're selling, because ultimately you have to prepare legal agreements for buyers that define the assets and liabilities, the people, the IP, etc., that they are acquiring. Once the perimeter is defined, you have to build a set of financial information that supports the assertions you're making about the business. This can be challenging in a carve-out situation, as the financial information must be created from scratch. Additionally, you will likely need to provide some form of audited financial statements to the buyer. As a seller, you want to be empathetic to buyers. Think about the information you would want if you were buying the business. Don't assume because you know the business that a buyer will automatically understand its value and future prospects. The information you provide has to reconcile to the perimeter of the business being sold. You need to provide detailed data books covering things such as financial, tax, market and commercial analysis, upside opportunities, detailed and grounded separation plans, employee relations and benefits, and a fully baked synergy analysis. It takes careful planning and execution from inception to closing and post-closing, as value erosion can happen all along the process. You need a lot more time than you ever imagine.
Now, Steve, what about from an operational consideration?
Sure, absolutely. The initial, we often like to think that we kind of talk separation as the other side of the coin from integration. There's a lot more similarities between the two than differences. So the initial steps to launch a separation and planning program are very similar to the ones we discussed, in an earlier show on integrations. And mainly that's to drive that overall vision for the separation into a set of clearly articulated operational goals, bake those into a team structure and methodology. You kind of customize the needs of that deal and then launch the planning program. All of that looks very, very similar, for separation versus integration. The added complexity in separation planning is really around a couple of areas: stranded costs, development of the transition service agreements, and what is often just a more traumatic impact from that change of control event itself, close. So a process that we like to call entanglement mapping can help sellers get in front of all these considerations. And what we mean by entanglement mapping is working through each major function within a company, looking at the major business processes within each of those functions, and getting a feeling for the people, process, systems, and contractual dependencies between the divested business and the parent. Once you document all these links, you can then form a preliminary plan for how you're going to sever them, ranging from, say, developing a standalone capability in the asset prior to close, which can be hard to do, to drafting a transition service agreement, which is much more common. We also mentioned that the legal separation event itself can be more traumatic for divestitures. This is particularly true for legal entity structures and contracts. On the entity end, for example, it's not uncommon for a seller to do what can be a fairly material amount of restructuring to gather the group supporting, the entity supporting the divested business into a package that you can more easily kind of slide through the close event. The contracts also require a little bit more care and feeding to move through that same event, maybe than the integration side. Change of control clauses that may not be triggered by a full company purchase are often impacted by asset sales. And a lot of surgery can be required to split those contracts into a fashion that now separately supports both the asset and the parent. So that's just a couple of examples of what makes the operational side of divestiture difficult, and what typically, in our experience, sort of like John mentioned, that you got to prepare the meal yourself. You just need quite a bit more lead time to prepare an asset for close when you're the selling party.
Well, interesting. Obviously, this is a very complex topic. So before we go, I'd like to ask, what other issues should the senior executive team consider or be aware of as regards to successfully considering or completing a divestiture or perhaps a series of divestitures? John, why don't you go ahead and start first?
Sure. So you want to ensure that management of the business to be divested are properly prepared going into a due diligence process. It's likely they've never been through the scrutiny of this type of process before. They need to be properly incentivized, and this is not only about money. Their future role and the fate of their employees are the most obvious of many non-financial issues that may be important to them. There needs to be emotional attachment through involvement and consultation with that management group throughout the process. The management team needs to be prepared to discuss upside opportunities and downside mitigation strategies relevant to the business. It's essential that they are persuaded of the merits of the arguments that only they can communicate convincingly. Lastly, you want to ensure that management time is only diverted to the sale process to the extent necessary. You need to get others to do heavy lifting in terms of preparing and verifying data. Management must be focused on driving the business forward to maintain and demonstrate value.
Now, Steve, what would you add to this list?
Sure. I think in addition to that technical complexity, we kind of talked a little bit earlier in our discussion, and John just spoke to, the cultural and change management dynamics of separations can be just really especially pronounced. And just to look at two quick areas, one, the employees in the divested asset often feel really torn between loyalties to their existing parent and the new buyer, which, they're going to be reporting to relatively rapidly. And there's almost an inevitable period in separation planning where a little bit of us versus them sets in place with the way that the parent looks at the employees in that divested asset. And it's really important to manage through that process. And then if you look at, some of, say, the back office teams that are providing the transition services, they're wondering what's going to happen to me when the TSA period ends. So there's just a lot of even more complex change management issues that come into play. And to deal with those, effective communications are always critical in deals of all types. But managing employee and stakeholder concerns into separation can be just a little bit trickier.
Today we've been speaking with John McPhee, a partner in KPMG's Advisory Transactions Services and the leader of Sell-Side Services, as well as Steve Miller, a managing director with KPMG Advisory and the national leader of KPMG's Integration and Separation Services practice. John, Steve, really, this has been a terrific discussion, and I truly hope that you'll agree to join us again sometime soon.
Thanks very much, Robert. Appreciate it.
Our pleasure, Robert. Thanks for the opportunity.
That was Steve Miller, the national leader of KPMG's Integration and Separation Services practice, and John McPhee, a partner in KPMG's Advisory Transaction Services practice and the leader of KPMG's Sell-Side Services, discussing divestitures. Please join us for our next episode when we speak with William Siller, the Ronald Edward Szynski Professor in Business Administration at the University of Virginia's Darden School of Business, about the thoughts and suggestions contained within his book, Financial Turnarounds, Preserving Enterprise Value, which he co-authored along with Henry Davis. Until then, this is Robert Barnwell and CFO Talk Radio wishing you all the best.
We hope that you have enjoyed this episode and found the material of value. To download a transcript of this episode, receive a free subscription to the show, or to learn more about this subject, we encourage you to visit Professor Barnwell's website at robertgbarnwell.com to explore the many executive briefings, presentations, case studies, and other resources available for immediate download. This has been a production of Robert G. Barnwell. All rights reserved.